The world has never been more indebted than it is today. Governments, corporations, and households collectively owe an unimaginable $315 trillion. That's more than triple the size of the entire global economy. And it grows every single minute of every single day. We're no longer borrowing for opportunity. We're borrowing to survive. 10% of everything humanity produces now goes to interest payments alone. Not paying down debt, just interest. And here's the truth almost no one dares to say out loud. This debt will never be repaid. It can't be repaid. The system isn't designed to settle accounts, it's designed to trap us in them. For decades, leaders preached the same cure for every slowdown: print money. Lower rates, expand credit, pump liquidity into the system. It didn't matter if the patient was sick or healthy, the answer was always more stimulus. The economy became addicted to cheap money. Businesses relied on constant borrowing. Consumers relied on rising asset prices. Governments relied on deficits that no one questioned. And soon, we crossed a line without noticing. We stopped allowing the economy to correct itself. We refused to let bad companies fail. We refused to let markets reset. Instead, we just kept printing. The deadwood piled up, and no one dared to touch it. Now the forest is dry, fragile, and incredibly flammable. One spark could ignite everything. To understand the danger, you first need to understand recessions. Not the media version, the real function they serve. Recessions aren't accidents. They are reset mechanisms built into capitalism. They clear out inefficiency and reallocate resources. Painful, yes, but necessary. Without this cycle, weaknesses accumulate silently. Zombie companies rise and thrive on borrowed time. Entire industries get bloated and unproductive. Cheap money keeps failures alive far longer than they should be. A real recession ends that. It forces the economy to breathe again. But we haven't allowed that process in almost 2 decades. Every slowdown has been met with intervention. Every tiny fire has been smothered instantly. And without small fires, dry brush builds up. Until the only possible outcome is a massive blaze. We've reached that point now. And the $315 trillion in global debt is the fuel. Debt that was cheap when rates were zero. Debt that made sense when money was nearly free. But money isn't free anymore. Rates are much higher. Inflation makes cutting rates dangerous. And borrowers are hitting a refinancing wall they cannot climb. Companies that borrowed at 3% now face 8% or higher. Mortgages that were once affordable suddenly double in cost. Governments that relied on low interest payments now face fiscal nightmares. The math no longer works. And the cracks are already showing. Layoffs rising, companies freezing hiring, investments slowing dramatically. Consumers cutting back for the first time in years. The recession isn't coming, it has begun. But this one is different. It isn't driven by overinvestment in tech or real estate. It isn't correcting a single sector. It's being triggered by global uncertainty. Trade wars, geopolitical tension, and unpredictable policy shifts. This is recession by confusion. This is recession by chaos. And with $315 trillion in debt tied to the system, chaos is lethal. When debt defaults begin, they don't happen quietly. One company misses payments. Then its lenders take losses. Those lenders default on their own obligations. Pension funds face shortfalls. Insurance companies struggle to stay solvent. A chain reaction begins. The same mechanism that collapsed 2008, but much larger, because the leverage today is far higher. The derivatives exposure today is far riskier. And the systemic fragility is far worse. All it takes is a spark, and sparks are everywhere. Wars disrupting trade routes, rising energy prices, a slowdown in manufacturing, a government default in a developing nation, a major corporation collapsing overnight. Any one of these could trigger a cascade. Because debt doesn't fail gracefully, it fails violently, and once confidence breaks, it breaks all at once. People rush to pull money out. Markets freeze, lending stops. Businesses can't roll over debt, and within days, the recession becomes a crisis. A crisis becomes a panic, and a panic becomes a global collapse. This is the scenario economists whisper about behind closed doors. A recession fueled by the biggest debt mountain in human history. A downturn with no cushion, no room, and no easy escape. But here's the part that almost nobody is prepared for. A recession in a heavily indebted world behaves differently. It's not a pause, it's a breaking point. Because when debt stops rolling over, the system stops breathing. Credit is the oxygen of modern economies. Cut off oxygen and everything suffocates at once. Businesses can't fund payroll. Banks tighten every lending standard overnight. Consumers slash spending to survive. And governments suddenly face impossible math. Tax revenues fall just as expenses rise. Social programs expand when unemployment surges. But interest payments still demand their share. Debt doesn't wait. Creditors don't pause for recession. The system keeps collecting, and that's when cracks widen into fractures. Many countries are already near the edge. Japan is drowning in government debt. Italy's fiscal stability is hanging by threads. China is battling a real estate collapse. The US faces record deficits, even in peacetime. Every major economy is trapped in the same cycle. Debt grows faster than GDP. Growth slows faster than debt. It's a mathematical dead end, and recessions accelerate the collision. The irony is staggering. We used debt to avoid recessions. But now debt ensures the next recession will be devastating. A trap we built one interest payment at a time. So what happens next? The same sequence history always follows. First comes denial. Leaders claim the fundamentals are strong. They blame temporary factors. They insist recovery is around the corner. Meanwhile, data quietly worsens. Markets grow nervous. Layoffs continue. Then comes the policy panic. Emergency meetings behind closed doors. Sudden rate cuts. Liquidity injections. Stimulus packages rushed into existence. And when that doesn't work, something bigger breaks. A bank falls unexpectedly. A major corporation collapses. A government defaults on foreign bonds. Confidence evaporates instantly. That's when the public realizes the truth. The illusion of stability was held together by cheap credit. And the credit is gone. Markets freeze because no one wants to lend. Banks hoard cash to protect themselves. Businesses run out of liquidity. Unemployment spikes far faster than expected. Governments try to limit damage. But their tools are weak and slow. Cutting rates risks inflation. Printing money risks currency collapse. Borrowing more becomes impossible. They are pinned from all sides. And when governments are trapped, citizens pay the price. Companies close that should have survived. Jobs vanish that won't return. Pensions lose decades of savings. Families struggle with rising costs and falling incomes. The middle class shrinks. The poor grow poorer. The wealthy move assets overseas. Capital flees instability. And the recession deepens into something darker. That something darker is what economists fear most. A debt deflation spiral. Prices fall because demand collapses. Falling prices make debts harder to repay. Harder debt repayment leads to more defaults. More defaults reduce lending. Less lending reduces investment. Investment collapses, unemployment surges. And the spiral continues downward. It's the economic equivalent of a whirlpool. Once you're in, escaping is nearly impossible. This is why central banks fear deflation more than inflation. Inflation erodes purchasing power, painful but survivable. Deflation destroys economies. And a recession mixed with record global debt leads directly to deflation. Because defaults pull money out of the system. When money disappears, spending disappears. When spending disappears, jobs disappear. And when jobs disappear, consumption collapses. It's a feedback loop with no natural bottom. History shows the only escape is massive restructuring. Debt forgiveness on a national scale. Bailouts, haircuts, forced mergers, and sometimes complete currency resets. These measures are politically impossible until crisis forces them. And once crisis hits, it moves too fast for orderly solutions. That's the danger we're walking into, a recession that outruns the rescue. Because $315 trillion cannot be stabilized in a panic. It can only collapse or be restructured violently. And global leaders know this quietly. That's why the messaging has changed in recent years. Less optimism, more warnings. Less temporary slowdown, more structural risks. They see the storm forming long before we do. They know the debt wall is real. They know the refinancing crisis is unavoidable. And they know the next recession will not look like the last. It will be deeper, faster, more interconnected, and far more destructive. Because everything today relies on credit. Supply chains rely on overnight lending. Corporations rely on rolling debt. Consumers rely on credit cards and mortgages. Governments rely on deficit spending. Remove credit, and the entire structure shakes. Remove it suddenly, and the structure collapses. So what do people do when collapse threatens? They move into assets that governments can't print. Gold surges, real estate becomes a refuge. Some flee into crypto, others hoard cash, expecting deflation. Everyone seeks safety in different ways. But the one thing they all do is move fast. Because in a crisis, money moves quicker than governments, and ordinary citizens always move last. They react only after markets react. They adjust only after companies adjust. And they panic only after the wealthy already left the burning building. This is why understanding the cycle matters. Those who understand early prepare early. Those who don't suffer the consequences. Recessions don't destroy everyone equally. They destroy the unprepared. And they transfer wealth from the many to the few. Every crisis in modern history shows this pattern. Risk rises for the poor long before it rises for the rich. Opportunity rises for the rich long before it rises for the poor. And recessions accelerate both trends dramatically. Because when assets crash, wealthy buyers emerge instantly. They purchase land, stocks, businesses for pennies. They expand influence while others try to survive. The game resets, but not for everyone equally. And this recession, fueled by unprecedented debt, will amplify the imbalance. We are about to witness the largest wealth transfer of our generation.